Assalamualaikum and hi. Today we would like to present about Transnational Audit. But before going into that, I would like to introduce myself and my group members. My name is Afifa binti Aznan and my group member is Nur Atika Sharmi and Farah Shahira. First and foremost is the definition of Transnational Audit. As per the Constitution, transnational audit is an audit of financial statements which are or may be relied upon outside the audited entity's home jurisdiction for purposes of significant lending, investment or regulatory decisions. While according to TSC guidance, there are a few audits that categorized as transnational audit, such as audit entities with listed equity or debt, entities in either the public or private sectors where there are reasonable expectation, audit of foreign subsidiaries, and audit of banks and other financial institutions.
Assalamualaikum and hi, my name is Farah Shahira binti Azisha. So next, I'm going to talk about example of transnational audit. First, the audit of national charity accepting donation in a country where it is based and match funding all over the world. It is not confirmed and clear that users outside the country charity base rely on the financial statement. Consider whether the financial statements are being used outside of the country in which the charity is based for significant lending, investment or regulatory decisions, which would qualify as transnational audit. It is also important to consider if the size of nature of the products and services provided affected the audit of transnational. The larger the charity is, the higher chances for the audit to qualify. Second, an audit of an international charity that accepts donation through various national branches and distribute funding all over the world. The nature of this entity is clearly stated as transnational. Moreover, the donors and others outside the charity's home jurisdiction can be used to create a reasonable expectation that the financial statement for the international structure. Therefore, this charity's audit is qualified as transnational. Third, the audit of an internal stockbroker who is only permitted to trade with local residents and on local exchange under local securities laws. The transnational audit will be not classified if no transnational user can be demonstrated and does not trade across national borders, but except for the stockbroker is large enough to qualify under the size criteria. For example, given the restriction on trading and investing, but their chances are low, therefore the broker's audit will be not classified as a transnational audit. And lastly, the audit of a private internet betting company registered in the British Virgin Islands that operates from Costa Rica and accepts credit card gambles on a global scale via the internet. Internet gambling does not fall under the nature of the business category, so audit is unlikely to qualify as transnational under the second criteria. However, other potential users such as government or regulators in other countries could rely on the statement and the audit would be classified as transnational audit, but additional information is required. Furthermore, assuming there are no restrictions on gamblers, it clearly operates across borders, but gamblers are unlikely to rely on the financial statements. Next, association involved. The company that is involved is listed on multiple stock exchanges and also intend to raise more capital for the company. All of that refer to the subject of the regulation of all stock exchanges that are listed. The company that involved in transnational audit is the Forum of Firms, FOF. FOF is a non-profit organization of international network of firms that perform transnational audit. The forum's goal is to promote consistent and high-quality financial reporting and auditing practices around the world. By bringing together firms that perform transnational audit and involving them more closely with IFASC's audit and the other assurance-related activities. Next, members of forum agree to maintain quality management standard is according to IASB's International Standard on quality management as well as relevant national quality control standard. Not only that, having policies and methodologies is in place for conducting transnational audit. They are to be greatest extent possible based on the international standard on auditing issued by the IASB. The second company that is involved in transnational audit is Transnational Auditor Committee, TAC, serve as the organization's official close collaboration with the Forum of FOF. It is primarily in charge of carrying out and advising the forum's objective and operation, plays an important role in encouraging forum members to conduct high-quality international audit by requiring adherence to certain international standards as a condition of membership. They also provide a forum for the exchange for the best practice in areas such as quality, management, auditing, independence, training, and continuing professional development. At the same time, they facilitate interaction among multinational corporations, national regulators, financial institutions, and other stakeholders on audit quality. Next, feature of transnational audit. First, control risk as a result of corporate governance requirements. In some countries, the auditor must consider the part of audit process as its very normative corporate governance requirement. To ensure group-wide compliance, the auditor must perform additional work to fulfill the requirement of the cities and countries that are relevant to the financial statement. However, some countries have a very little governing regulation and other components are likely to weak to control. Every risk have different control risks which is likely to cross a group various subsidiaries. Second, framework for financial reporting. Different countries have their own way, as some use international financial reporting standard while others use accounting standard developed locally. Transnational groups are likely to have adjustment, reconciliation, or restatement as its very requirement to make sure transnational are relevant to financial statement. The high level of technical expertise can be complicated and necessity for preparer and auditor. Third, auditor regulation and oversight. There are many numerous ways auditor activity are regulated and monitored around the world. Similar to the previous comment on the use of IAS, in some countries the audit profession is self-regulatory, whereas it is more legislative in others. The impact of quality working of audit can be seen through this. Lastly, auditing standards are used. Many countries already adopted international standard of auditing, ISAs, but there are still some countries who have not. Instead opting to use auditing regulation developed locally. Moreover, there are some countries that have modified the use of ISAs. However, inconsistent audit processes are resulting because the group financial statement may have been audited using a different auditing framework, and it will potentially lower the audit's overall quality.
Assalamualaikum and hi, my name is Nuratika Sharmi binti Zulkifli and I will be presenting the concern of transnational audit. Multinational group audit has two main concerns, which are audit cost and audit quality. First one is audit cost. It refers to the amount of fees received by auditors for their professional service based on such factors, such as the complexity of service, the level of expertise, and many other factors. These fees are agreed upon between the auditors and the client prior to the start of the engagement and are included in the engagement letter. The most cost-effective way for transnational audit is to select the combination of auditors that are capable of completing the group audit with desired quality and at the least cost. They must consider whether the choice of another component auditor will save the engagement cost or the principal auditor conducted the audit as wholly will save the cost. In fact, group audits performed entirely by principal auditors may be less expensive than those involve additional components auditor. However, if a principal audit firm to audit an entire group, it does usually incurs additional costs. Audit firm networks are more expensive at delivering audit service despite their well-developed modes and means of the communication, common protocols and methodologies in a multi-location setting relative to those that would be incurred when a local unaffiliated auditor is involved. Engaging a local audit team for international travel and when gathering audit evidence for overseas component of a group can save some more audit costs. It is because they are probably more familiar with the local laws and regulations such as tax, enterprise, securities laws, which will cut down the amount of time needed for the audit. They also may be more familiar with the local company environment and management, as well as the most effective method of gathering relevant evidence rather than using the principal auditors. The next one is audit quality. Audit quality also becomes one of the main concerns of transnational audit. In responding to this concern, ISA 600 requires that auditors partners of the principal firm to bear the liabilities for the audit opinion expressed on the corporate group financial statement, regardless of whether the work was performed by the principal network firm, affiliate network firms member, or unaffiliated auditors. Signing partners has to ensure that the consolidated account as a whole accurately present the financial performance, and it is his responsibility to ensure that all components of an operations are carried out at similar high degree of quality. Other component auditors are generally driven to meet the required audit quality. If they fail to produce audit evidence of required quality, or if the principal's auditor spend too much time contracting and monitoring, the partnership is unlikely to last. This is because there may be information asymmetry regarding the scope and quality of the work performed. The presence of other auditors in a group audit creates an issue for the signing partners and principal. Different national practices, standards, or view of the standards may cause issue. Poor coordination and control issues also may result in inadequate audits. There are a few challenges that faced by multinational group auditors. Issues or limitations in multinational group audits are likely to arise when the client is relatively large and lead to more complexity in work. The larger the companies, the more comprehensive audit works are carried out, and it presents higher audit risk. Due to the differences in local jurisdiction, the company's auditors in the other countries may discover it hard to predict or understand the group auditors' actions and instructions. Furthermore, larger public companies are more likely to engage in transactions that complicate the company's auditors' work. Thus, large companies likely to cause auditors challenges in performing audit work. Second challenge of the transnational audit is the structure of a global group audit, as it may influence the level of complexity. There are different numbers of components all across the globe in the global group audits. The group auditor must clarify the audit procedures to more components teams and evaluate their works to assess the sufficiency and reliability of the evidence. Group audit also can differ in organizational structure, like the involvement of other teams, multiple levels of reporting, and the statutory audit responsibilities of the component. Last but not least, hiring component auditors in the foreign countries where the client conducts business is also likely to make it more difficult to complete interdependent works. This is because the complexity brought by the language and cultural barriers. Such variance might lead to more disparity on teams member evaluations and decisions, which would make it harder for a group to develop a clear and common understanding. Next, let's look into the issue of transnational audit. Graham Sterling has raised a few concerns about transnational audit while highlighting Grant Thornton's auditing capabilities on their website. One of them is the difficulty with compliance in international group audit. The ISA 600 standard expressly acknowledged that the group auditor is accountable for the conduct, supervisions, and effectiveness of the group audit. Even if an overseas auditor is involved, the group auditor is solely responsible for signing the group audit report and is also at risk. And according to ISA 600, the group audit was expected to identify any overseas auditor's work on the financial data and international subsidiary and explain the standard for them. Since the signed local statutory financial statements cannot be relied upon for the group audit processes, the group auditor must be involved in the planning, fieldwork, and concluding procedures of the part audit of the overseas auditor. Unfortunately, by way of formal financial statements audited and published by local accounting firms, audit firms are routinely required to sign off on commodity financial statements. Next is to uncover hidden expenses by bringing in auditor of unaffiliated components. Graham stated that although it was impossible to access the local auditor work papers, there might also be a language barrier. They once received a file that was written in the Cambodian language, which made it incredibly challenging for them to fully comprehend it because none of their team members could read it. Aside from that, they are unable to rely on the job provided since they disagree with the technical accounting treatment approved by a component auditor. This caused them to re-audit both cases due to the strict criteria of ISA 600. All of this will cause an increased audit fees and a delay in the delivery of the group audit reports. Along these, they also lost the initial cost benefits from hiring a small local auditor because it ended up demanding a more costly and time-consuming group audit. In addition to all of this, Graham has faced numerous additional difficulties with international audit. One of them is restriction on access to work papers, which prevent the company auditors from reviewing their work since some of them did not retain audit evidence in a format that could be easily shared. They also had to invest greater fees for international trips to review the component auditor's work. Finally, he emphasized how difference in language, culture, audit methodology, and time zones could make communication between unaffiliated companies across borders challenging. That's all from me. Thank you.
As conclusion, this project has increased our understanding about transnational audit. The concern of multinational groups audit regarding the audit cost and quality may help the group auditors to enhance company auditors' personnel and get a deeper understanding of the audit engagement. Group audit should look for ways to better and deal with the limitation of international audit. Few ways that have been found to help minimize the transnational audit challenges are implied coordination, modularization, and ongoing communication. A better understanding of this aspect should help the company's auditors apply the information provided to them in appropriate manner and enhance the decision reliability. That's all from our group. Thank you.